One morning in the United States, fuel prices tick slightly higher, not enough to cause panic, but enough to be noticed. Truck drivers pause at the pump. Logistics managers recheck their costs. Families quietly adjust their budgets. There is no major crisis headline, no sudden supply shock. And yet, something is shifting. Because this time, the pressure isn't coming from across the ocean. It's coming from the north. From a country that rarely escalates tensions publicly, but may be changing the rules of the game quietly. Canada. At first glance, nothing seems unusual. Oil is still flowing. Pipelines remain active. Tankers continue moving across borders. Trade between the United States and Canada appears stable, almost routine. There are no breaking news alerts, no emergency policy announcements, no visible signs of disruption. From the outside, the system looks intact. But beneath that surface, something is beginning to change. Across key regions of the United States, energy costs are starting to move, not sharply, not dramatically, but steadily, gradually, consistently, almost silently. This is not the kind of sudden price spike that grabs headlines or triggers public panic. Instead, it's the kind of shift that moves quietly through layers of the economy. It begins deep within the system. At refineries, where crude oil is processed into usable fuels, small increases in input costs start to appear. Nothing extreme at first, just enough to tighten margins. From there, the pressure moves outward. Fuel distributors begin paying slightly higher wholesale prices. Transportation companies start recalculating operational costs. Logistics networks, the backbone of modern commerce, begin adjusting to a new reality. And then, slowly but inevitably, the effects reach the broader economy. Diesel prices begin to edge upward. Freight costs increase across regional and national routes. Agricultural operations, heavily dependent on fuel for machinery and transport, start to feel the strain. For farmers, even a modest rise in fuel expenses can affect planting, harvesting, and distribution decisions. For trucking companies, tighter margins force difficult choices: absorb the cost or pass it on. And in most cases, those costs don't disappear. They move forward, into supply chains, into retail pricing, into the cost of everyday goods. At first, the impact feels minor. A few cents more at the pump, a slight increase in shipping fees, a barely noticeable shift in operational budgets. But over time, these small changes begin to compound. What starts as a subtle adjustment gradually becomes a measurable trend. Businesses begin to notice patterns. Analysts start tracking consistent upward movement. And consumers, even without seeing the full picture, begin to feel the difference in their daily expenses. This is how systemic pressure builds, not through sudden shocks, but through quiet accumulation. And that's what makes this situation so important. Because when changes happen slowly, they are often harder to detect, but much harder to reverse, which leads to a critical and unavoidable question. If supply hasn't been disrupted, if oil is still flowing, if trade remains active, then what exactly is driving these rising costs? And more importantly, where is the pressure really coming from? To truly understand what's happening, you have to look beyond surface-level numbers. Because on paper, the situation doesn't seem to make sense. The United States is one of the largest energy producers in the world. Its oil output ranks among the highest globally. Domestic production has surged over the past decade, driven by technological advances and expanded drilling activity. By many measures, the U.S. appears energy dominant. But that's only part of the story. Because at the very same time, the United States remains deeply dependent on imported crude oil. And not just in small amounts. A substantial portion of the crude processed in American refineries comes from outside its borders. This is where the situation becomes more complex. Because it's not simply about how much oil is produced. It's about what kind of oil is produced and what kind of oil is needed. Across key regions of the United States, particularly in the Midwest and along the Gulf Coast, many refineries were built and optimized decades ago to process a specific type of crude oil, heavy crude. This type of oil is thicker, denser, and more sulfur-rich than lighter varieties. It requires specialized equipment and complex refining processes to convert it into usable fuels like gasoline and diesel. Over time, entire industrial systems were designed around this input. Refineries were engineered for it. Supply chains were built to deliver it. Infrastructure was aligned to support it. And this matters more than it might seem. Because heavy crude is not easily interchangeable with the lighter oil that dominates U.S. domestic production. You can't simply swap one for the other overnight. Switching between crude types is a complicated process. It involves significant engineering modifications, costly equipment upgrades, extended shutdown periods, and in many cases, years of planning and billions of dollars in investment. So even though the United States produces large volumes of oil, much of that production doesn't perfectly match what its refineries are designed to handle, which creates a gap, a structural mismatch between supply and capability. And that gap is filled by imports, primarily from one source: Canada. Canadian crude, particularly its heavy oil, fits seamlessly into the existing U.S. refining system. It flows through established pipelines. It integrates efficiently into refinery operations. It supports a system that has been built and refined over decades. This is not just a convenient trade relationship, it's a deeply embedded dependency, a system where production, transportation, and processing are all interconnected, which means when something changes within that flow, even slightly, the system doesn't break immediately. There are no instant disruptions, no sudden shutdowns, but the pressure begins to build quietly, gradually, and because of how interconnected everything is, those changes become increasingly difficult to avoid. The effects may not be immediate, but over time, they become unavoidable. Now add another layer to this story, because what we're seeing in energy markets doesn't exist in isolation. It's tied to policy. And in recent years, trade tensions have once again become a central tool in U.S. economic strategy, particularly under the approach associated with Donald Trump. During this period, tariffs returned to the spotlight, not as a secondary option, but as a primary instrument of economic leverage. The idea behind them was clear: apply pressure on trading partners, protect domestic industries from external competition, and ultimately reshape trade balances in favor of the United States. On paper, the logic is straightforward: increase the cost of imports, encourage domestic production, and push foreign suppliers to adjust their behavior. In many industries, this approach can produce visible results. Manufacturing, for example, can respond relatively quickly. Supply chains can shift. Alternative suppliers can emerge. But energy markets are different. They don't operate on short timelines. They are slower, more rigid, and far more complex. Energy systems are built over decades, not months. Pipelines stretch across borders. Refineries are engineered for specific inputs. Logistics networks are tightly integrated, which means when policy changes are introduced, especially something as blunt as tariffs, the system doesn't simply adjust overnight. Instead, it absorbs the pressure. And that's where things become less predictable, because in energy markets, the effects of tariffs don't always follow a direct path. They don't just hit foreign producers and stop there. They move through layers, through contracts, through pricing mechanisms, through infrastructure constraints, and sometimes they circle back. A policy designed to apply external pressure can end up creating internal strain, not immediately, but gradually, subtly, and often in ways that are difficult to trace in real time. This is what makes energy different from most other traded goods. You can't quickly replace suppliers, you can't easily reconfigure infrastructure, and you can't bypass physical limitations with policy alone. So when tariffs enter this kind of system, they don't just change trade flows, they change incentives. They alter risk calculations, they influence pricing decisions, and they reshape how participants across the market respond. Which brings us to a critical turning point in this story, because while the United States was using tariffs as a tool of pressure, Canada, its largest energy partner, faced a choice: respond directly or respond differently. And what followed was not the kind of reaction most people expected. Canada did not respond with aggressive counter-tariffs. There were no dramatic press conferences, no escalating political statements, no visible attempt to match pressure with pressure. From the outside, it almost seemed like there was no response at all. But that perception is exactly what makes this moment so important, because instead of reacting loudly, Canada responded quietly, and more importantly, strategically. Rather than disrupting supply or triggering a direct confrontation, Canada chose a different path. It left the physical flow of oil unchanged. Pipelines continued operating. Exports continued moving south. The system, at least on the surface, remained stable. But beneath that stability, the terms of trade began to shift. Pricing structures, often overlooked by the public, started to evolve. Contract premiums were adjusted upward. Transportation costs were recalibrated to reflect new conditions. Risk pricing began to incorporate the uncertainty created by shifting trade policies. Individually, none of these changes seemed dramatic. There was no sudden spike that would trigger alarm, no single moment that could be pointed to as a turning point. But together, they began to reshape the economics of the entire system. And that's what makes this approach so effective. Because in global markets, prices are signals. They communicate risk. they reflect conditions, and they influence behavior instantly. Unlike political measures, which can take time to implement and even longer to produce results, pricing adjustments move immediately. They are felt in real time. And when those adjustments are applied consistently, even at modest levels, they begin to compound. A slight increase in premiums here, a marginal rise in transport costs there, a subtle shift in how risk is priced into contracts. Individually, these changes may appear insignificant, but across large volumes of oil, across long-term supply agreements, and across interconnected systems, they translate into substantial financial impact. Billions of dollars can shift, not through dramatic action, but through quiet recalibration. This is not economic confrontation in the traditional sense. It's not about cutting supply or imposing direct penalties. It's about influencing outcomes through structure, through the mechanics of how markets operate, and in this case, that influence began to move through the system, slowly at first, almost invisibly, but with increasing momentum, because once prices change at the source, everything downstream begins to adjust. And that's exactly what happened, without escalation, without disruption, but with undeniable effect. Once costs begin to rise at the input level, they don't stay there. They can't. Because energy sits at the very foundation of modern economic systems, and when pressure builds at the base, it inevitably moves upward. The first to feel it are refineries. These facilities operate on carefully balanced margins. They depend on stable input costs to maintain profitability and efficiency. So when the price of crude begins to edge higher, even slightly, the impact is immediate. Margins tighten, operational costs increase, efficiency targets become harder to maintain. At first, refineries may try to absorb the pressure. They adjust internally. They optimize processes. They look for ways to maintain output without raising prices. But there's a limit to how much they can absorb. And once that limit is reached, the next phase begins. Costs start moving downstream. Fuel distributors, who purchase refined products in bulk, begin paying higher wholesale prices. For them, this isn't optional. It's a direct reflection of upstream costs. So they adjust accordingly. Prices at the distribution level begin to rise. From there, the impact spreads into transportation networks. Trucking companies, responsible for moving goods across cities, states, and entire regions, face higher fuel expenses. Rail operators experience similar pressure. Airlines see increases in operating costs tied directly to fuel, and in response, they make adjustments. Shipping rates increase, logistics contracts are renegotiated, delivery costs begin to climb. At this stage, the pressure is no longer contained within the energy sector. It has entered the broader economy, and eventually, it reaches the final destination, the consumer. At the gas station, prices tick upward, not dramatically, but noticeably over time. At the grocery store, the cost of transported goods begins to reflect higher logistics expenses. Construction materials, retail products, agricultural outputs all begin to carry the weight of increased fuel costs. Because energy doesn't just power vehicles, it powers movement, it powers production, it powers distribution. In many ways, it powers the entire economy. So even modest increases at the beginning of the chain can ripple outward, affecting inflation rates, influencing business decisions, shaping household budgets. For businesses, higher energy costs can mean tighter margins and difficult choices, whether to absorb losses, increase prices, or reduce operations. For households, it shows up in everyday expenses. Commuting becomes more expensive. Groceries cost more. Essential goods carry higher price tags. And what makes this process particularly significant is how quietly it unfolds. There is no single moment of disruption, no clear point where everything changes at once. Instead, it happens gradually, step by step, layer by layer, until the cumulative effect becomes impossible to ignore. And by the time it's fully visible, the pressure has already spread throughout the system. At this point, a logical question emerges. Why doesn't the United States simply switch suppliers or rely more on its own production? The answer lies in infrastructure. Refineries are not flexible systems. They are engineered for specific types of crude. Switching from heavy to light oil is not a simple adjustment. It requires extensive retrofitting, long shutdown periods, massive capital investment, in some cases, tens of billions of dollars. And even then, the transition takes years. Not weeks, not months, years. So in the short term, refineries don't have many options. They absorb higher costs or pass them on, which brings the system back to the same place, rising prices. This situation hasn't gone unnoticed internationally. Countries in Europe and Asia are watching closely. Because what's happening here is more than a regional issue. It's a case study, a demonstration of how economic influence works in modern markets. Canada didn't escalate tensions, didn't disrupt supply, didn't violate trade agreements. Instead, it used pricing mechanisms, subtle, controlled, effective, and that sends a message. Power in global trade isn't just about size. It's about position, control over key resources, integration into supply chains, and the ability to influence costs without confrontation. For the United States, this creates a difficult reality. On one hand, the country promotes itself as energy independent. On the other, its infrastructure tells a more complex story. Dependence doesn't always mean lack of resources. Sometimes it means lack of flexibility, and that's the contradiction exposed here. Tariffs were designed to increase leverage, but in this case, they may have revealed limitations instead. Because when a system is deeply interconnected, pressure applied in one place can return from another. Looking ahead, several paths are possible. One option is adaptation. The U.S. could invest in refinery upgrades, diversify supply sources, reduce structural dependence. But that takes time. Another option is policy adjustment. Reconsider how tariffs apply to strategic sectors like energy. Balance political goals with economic realities. And then there is a third possibility: continuation. Maintaining current strategies and absorbing the long-term costs. Each path comes with trade-offs: economic, political, strategic, and none of them offer quick solutions. What this situation ultimately reveals is something deeper than a trade dispute. It shows how power actually works in a connected global economy, not just through policies, but through systems, through infrastructure, through dependencies, through time. Canada didn't need to escalate to make an impact. It only needed to understand where its leverage existed and use it carefully. For the United States, the lesson is more complex. Strength is not just about production, it's about adaptability. Because in a world built on interdependence, control is rarely absolute. And sometimes, the strongest position on paper is not the one that decides the outcome.